Good morning to all of you. So we are today back again for what? To discuss about PGBP. So I'm sure that you all are interested to continue the chapter that where we left yesterday. So what do we do when we start? To have a continuity, right? So let's have a small continuation session. Okay. So typically what we will be doing is we will try to recap. We'll try to recap the day one. Okay. So whatever we did, whatever we discussed in the last class is basically PGBP, right? So we spoke about the concept of profit and gains, the principles of business and profession, the definition of business, what does profession mean, and right. So we discussed about that. So we said profession includes occasion and all that. Then we spoke about the charging section, section 28, where we said we listed various line items which we said are taxable under business or profession. So section 28 is the charging section. Then we discussed about section 29, which provides a structure of computing the PGBP. So typically the structure, when you say structure, you understand what is allowed, what is not allowed. So we spoke about section 30 to 37, which are called admissible deductions. Then we discussed about 40, which are called inadmissible deductions. Then you have 40A, which is inadmissible in certain situations, only on certain circumstances. And then we had 43B, which is disallowed based on payment mode. So we discussed about the accrual concept and cash accounting system. So 43B provides that some expenditure are always allowed only on cash based accounting. Then we said there is section 41, which talks about profits chargeable to tax. That is nothing but deemed income. Okay. So this is the structure. Then we started with section 30, which is what? Which is basically RRR, right? So rent, rates and taxes, repairs and maintenance, and then insurance. So RRR and then insurance is allowed for building. We spoke about this situation in which it is allowed. Then we discussed about section 31. 31 is basically about rates and taxes, repairs and maintenance, and insurance for plant and machinery and furniture. So that's for the asset. So that's the next thing. So, and then we started with 32. There are 3 rules for 32, where we said basically there must be a specified asset. Then there must be it must be used for the purpose of business. And then it must be wholly or partly owned by the assessee. We discussed that. So this is all about what we saw in the last class, right? So to just remember, I would tell all of you a method which you can actually follow, start following it. See, whatever we discuss in this 2.5 hours is typically, like, I keep speaking, and considering these online classes, it's like a monologue. I continue to speak throughout the session. Whenever you have some queries, of course, you post it and I address it now and then. But will this help in you remembering of what was discussed? Remembering what was discussed? No. Okay. It doesn't. We all have a similar memory. So there's nothing to blame about it. We tend to forget. Whatever is discussed remains in your memory for quite some time. And then you of course, you forget. So what do we do? So typically, a 15 minutes, please remember, a 15-minute recap. Once the session is over, probably later in the day, like afternoon or even in the evening, just recap the entire session. Of course, I'm uploading the notes and slides immediately. So just go through it and understand what exactly was discussed. So 15-minute recap of what was discussed will help you remember the entire session for a very long period beyond your examination. So please, let's make sure that we have this habit from today, not only for tax. You can follow this for all of the sessions. Typically a 15 minutes recap, just refresh on whatever was discussed through the day, and so that we will remember this for a very longer period beyond our examinations. Okay. So we will continue in today's session after having some MCQs on the topics that we discussed yesterday. So whatever was discussed in the last class, we'll have it as an MCQ. Okay. So typically, Mr. Kashyap is a proprietor, and during the previous year 22-23, he has received export incentives. Okay. So we are talking about a concept of export incentives. So when we read this export incentive, we should remember the section which talks about what are all chargeable to PGBP. What are all chargeable to PGBP? That is nothing but what? The charging section 28. So this export incentives, we need to know what is the circumstances. So a proprietor has been receiving this export incentives in this year. So what is the taxability? So we need to know whether it is exempt, whether it is taxable under section 28, whether it is exempt up to certain limits, or whether it is taxable under income from other sources. So what did we say? There is this section 28, which talks about various items listed in PGBP, which are taxable under the head PGBP. One of the item is subsidy and export incentives, subsidy, grant and export incentives provided. We saw various situations like cash assistance provided for exports, then duty drawback. Then we discussed about another duty drawback regarding customs. So these incentives which is given, as we spoke about a concept called Atmanirbhar Bharat, where we said we are encouraging manufacturing in India, sales in India. So which means whatever you are exporting, government encourages you to export through the subsidy, grant and incentives. So they are taxable under section 28. So if it is towards your revenue item, so if it's towards your revenue, that is, it's against your sales, exports made, then it is taxable under section 28. So the answer will be what? Sorry. So the answer will be taxable under section 28B. Okay. So that's the answer. Now we'll move on to the next question. So under the head business and profession, the method of accounting which an assessee can follow shall be. So there are four options again: mercantile system, cash system, mercantile or cash system, none of the above. Okay. So now we need to know what exactly is the method of accounting, correct? So the method of accounting, what did we say? We discussed about a section 145. Okay, we discussed about a section 145, which recommended certain method of accounting, recommended a method of accounting for not all heads of income, only couple of heads. So it's typically for PGBP and IFOs, that is income from other sources. So basically for PGBP and IFOs, what happens is there are couple of methods prescribed. So couple of heads, couple of methods. So what are the methods? Cash or mercantile system of accounting. Whichever you wanted to follow, you can follow. The only thing is, once it is followed, it must be uniform. So it must be uniform. So typically you can't change every year. So it has to be uniformly followed, unless you have a very strong reason. Okay. So we'll leave that aside, whether it can be changed or not. So for question purposes, we'll remember that you can choose whether it is cash or mercantile system, whichever is suitable to you. So the answer is not mercantile system only, it is not cash system only. So the answer is C, mercantile or cash system. So that's the answer. So your MCQ number 2 provides which method of accounting can be followed. So it is basically, it is both, that is mercantile or cash system, correct? So the answer is C, mercantile or cash system. Okay. So we'll move on to question 3. Okay. ARC and Co. has received a sum of 5 lakhs from Keyman Insurance Policy. Keyman Insurance Policy taken on the life of Mr. A, who is basically the CFO of ARC and Co. So now we spoke about this concept, and one of you questioned also, how do you differentiate between the Keyman Insurance Policy discussed in salary and discussed in business? See, I'm trying to repeat the queries. I'm trying to repeat the words that I stressed in the last class to say that try to remember them, okay? Because when I spoke about exports incentive, I talk about Atmanirbhar Bharat. So you can remember about the policy of the India, what happens. There could be various what you call memes on Atmanirbhar Bharat or something good that you remember about Atmanirbhar Bharat. So when you remember that, you remember export incentive, right? So you create mechanism to remember things by correlating it with something else. So similarly, when I speak about the scheme and insurance policy, I remember that one of you questioned in the last class about how do you treat it differently between the treatment that has been specified in salary and PGBP. There is also scheme and insurance policy discussed in salary, and it is also discussed in PGBP. How do we differentiate it? We said what is discussed in salary is from the employee's perspective. What is discussed in business is from the employer's perspective. So that's what we discussed. So now when we discuss that, we were discussing this when we were talking about section 28 only. So 28 said, what is the treatment of key man insurance policy? So now if some of you could recollect it, what did we say? It is a chargeable income under section 28. So key man insurance policy received, that is, let it be the sum assured, let it be the bonus. It is basically a section 28. Now we'll come to the what you call the options, the choices. So the first is exempt. Next is it is taxable under ARC under PGBP. Then it is taxable with ARC but under the IFOs. And then it says it is taxable under the employee standard is Mr. A. So it says it is taxable in the hands of Mr. A. Now, when you take these MCQs, even in an examination, so typically when you talk about MCQs, there are three ways of answering MCQs. There are three ways of answering the multiple choice questions. Okay. The first, I know the answer. I know the answer straight away out of A, B, C, D. I know which one is the exact answer. I know that. So I'm very clear. So that is the first option. The second option is typically ruling odd or now, trying to just rule out one by one. And finally, you will end up with only one, which should be the answer, which you think could be the answer. So it's like odd or out. So you're ruling one by one out. And finally, you're identifying the final answer by ruling one by one out. That's the second method. Okay, now the third method, I do not remember anything. I do not remember anything of what was discussed. Still, ICA is very grateful, very grateful. They don't give me negative marking. They don't give me negative marking. So I'll have to choose definitely one. I'll have to choose one out of these four. How do I choose? So I follow a method of whatever rhymes I remember or whatever simple thing that I remember to choose one. Okay. In my school days, it used to be this inky, pinky, ponky. So where you finally come out with end up with one, and that could be the answer. So typically the point here is there are three options. One, you know the answer rightly. Second one is you're ruling one out. Third, you are guessing. The preferred option is always number one. The preferred option is always number one. You should know the answer. Worst case scenario, you can always resort to odd or even, keeping one by one out. But my humble suggestion, never resort to third option. Yes, we don't have negative marking, but please don't resort yourself to third option, because that's where you develop confidence. Multiple choice questions gives you the confidence of knowing minute things in the subject. So it helps you in developing confidence. The more MCQs you are able to answer correctly, it gives you extreme confidence. So please make sure that you do that. Okay, coming back to the topic of this question itself. So as we said, it is a taxable section and it is not taxable in the answer of A, because we are talking about what is being received by the company. So what was being received by the company is taxable only under PGBP. So the answer is B, which is taxable in the hands of ARC and Co. under PGBP, right? Okay, so that is question number 3. Next one. Priya was carrying on an agency business of ITC products. So she is an agency, okay? So now when we say agency, we need to think about what all we discussed about agency. We spoke about a principal agent relationship on something about section 28. Okay, we'll continue the question. So she has received a sum of 7 lakhs. She has received a sum of 7 lakhs for what? For termination. For termination. So the compensation amount so received shall be what? So the question is, what will happen? So whether it is taxable, whether it is exempt, as it is capital receipt, because it's a one-time payment. So it is a capital receipt. So does that mean it is exempt? or it is fully taxable under PGBP, it is 50% taxable under PGBP, it is taxable under income from other sources. So now for those who know the answer straight away, I'm very happy. For the rest, probably we'll try to do this odd or not, right? So we are never going to guess, okay? We are never going to guess. Let's make this a practice of either following first method or second method to solve an MCQ. So typically, we remember that something was discussed about agency principle, where we said it is basically taxable in section 28 whenever there is modification, that is terms and condition. So whenever there is a change in terms and condition, or the modification, any modification of the agreements that we have made is typically discussed under section 28. So it is definitely not exempt. Okay, it is definitely not exempt. And this was discussed only in PGBP. So wherever we discussed, it is not taxable under other sources. So that's the next option. Now we need to go back and think, did we say entire amount is taxable or only partly taxable? Did we discuss anything, or did we study somewhere that this income is partly taxable? We probably don't vaguely remember that anywhere that it spoke about 50%, because section 28 everywhere spoke only about about taxability. It never discussed about partial taxability. So we can rule this also out, because the section never discussed about partial taxability. So the answer would be fully taxable under their business and profession. So that would be the answer, because whatever is removed, whatever is received for termination of agency or modifications of terms and condition of an agreement between two parties in business is taxable in the hands of recipient, because it is classified as a charge under charging section 28. Okay, clear? One last question. ARC Limited in the business of printing and publishing. And one more thing that I always need to tell you is, whenever there is a question, you need to give importance to each and every word. Some words are relevant, some words are not at all relevant for your answer. So please understand, we need to go through the question word by word. Some words are to give you extra information, some words are to confuse you. So that extra information, you need to take it and use it for your problem. You need to identify what is there just to confuse you. You need to keep that aside, ignore it as if that word never appeared in the question paper. So now one of the words that we are going to talk here is printing and publishing. Okay, their WDV as on 1st April 2022 was 7,50,000. That is your opening. Okay, so the opening is 7,50,000. Okay, and then your they have purchased. So the purchase date is 1st December. Is that relevant? Not relevant? Completely relevant, because depending upon the number of days, your depreciation changes. So now 2,50,000 is an additional machinery that has been purchased, which is an addition. So what is the provision that you need to remember? You need to remember section 32. There is nothing great about it. But when you remember 32, we need to also remember the concept of additional depreciation. So what is additional depreciation? It is typically when a machinery, a plant and machinery, a new plant and machinery has been purchased by an assessee engaged in manufacturing or power generation and distribution. When you said manufacturing, we said what? We said printing and publishing is also considered manufacturing, So now the business is printing and publishing. So they are eligible for what? Normal depreciation plus additional depreciation. So they are eligible for both. So the opening balance, and then you have an addition for 2,50,000, correct? So on that 7,50,000. So now we'll go through the answers. We'll just see how how the institute basically questions the thing. We'll go by one. Some of you might think that it is flat. Both of them put together is 15%. Okay, we'll understand that both of them is 15%. In that case, the answer is 1,50,000, correct? In that case, the answer is 1,50,000. Please remember, we have just assumed that it is flat 15%. So then it is 1,50,000. Now we know that, sorry, out of the 7,50,000, 7,50,000 is eligible for 15%. 2,50,000 is eligible for 7.5% because why? It is less than 85%. So now what will be the thing? So for 7,50,000, compute 50%, 15%. So how much is it? I'll just use my calculator. It is 1,12,500. And for 2,50,000, it is 7.5%, correct? So it is 18,750. So what is the answer now? It is 131,250, right? 131,250. So now we'll go back to the question. You have that also, right? You have that also. So some of you might think, who thinks that printing and publishing does not have additional depreciation, there is still an answer. There is still an answer in your choices. Please understand, you have a working for each of the number, right? You have a number working for each of the numbers. So which means you'll have to be very particular. As I told you, number one, number two. So only number one will give you the right answer in this question. Even odd one out will become very difficult. So guessing will never work out. Odd or not also might not work in kind of these questions because you should know the exact answer. You should know the exact provision. What carries away this provision? What carries away this provision is this word, printing and publishing. So the word printing and publishing, is that business eligible for additional depreciation or not? Yes, because there is an additional word where we said there is a circular which said that printing and publishing should also be considered as manufacturing. So once you do that, it automatically is eligible for additional depreciation. So now how do you compute? We'll do the another working. So it's basically 7,50,000 into 15%, no doubt about it. 2,50,000 into 7.5%, no doubt about it. 2,50,000 into, now there is an additional depreciation of 20%. There is an but since it is less than 180 days, it is 10%. It is 10%. So this is 1,12,500. This is 18,750, and this is what, 25,000, right? So the answer will be 151, 156, right? 156, 250. Okay. Now, do we have that in the option? Yes, we have. Okay, we have C, which is 156, 250. But if you actually look at it, there is also this 181, 250. Some of you might think this is 15% and this is 20%. Will still get an answer, 181, 250, who are ignoring 180 days. So one who ignore this date, 1st December 2022, might get another answer, which is 181, 250. So please understand, you might have an answer, all of the things. Once you think you get the answer, doesn't mean you're right. You must get the provision right. You must get the provision right. When do you get it right? When you remember, printing and publishing is also manufacturing. Less than 180 days. Correct? Less than 180 days. So these two keywords is what has driven this question. So please understand, each word in the question matters. That's what will help you decrypt the question to see what is required, what is not required. So here, two keywords was printing and publishing and 1st December 2022, which only resulted in knowing the answer correctly. So what is the answer here? It is 1,56,250 because it is less than 180 days and they are eligible for additional depreciation at half of the additional depreciation. That is 10%. Clear? So that's what I wanted to convey through this multiple choice question. Just to recap and also tell you some of the tips relating to how to, what is the advantage of solving multiple choice question. It helps you understand the provisions in minute level details. It helps you notice minute details in a provision. So please understand that. Okay. So with that, we complete a small recap. I know that I took a little longer time for recap itself, just to stress few things for you to make sure on what should be the objective while preparing multiple choice questions or the subject as a whole. So just with that note, we will continue with what we need to learn today. So what we need to learn today is typically the next sections, right? So we discussed about section 32. We discussed about what is depreciation. Now, when we said depreciation, there are a couple of key words in depreciation, okay? There are a couple of keywords. So the keywords is typically cost and WDV, okay? So these are two critical words in calculating depreciation, because you need to know on what you need to calculate depreciation, right? So you will be calculating depreciation either on cost or on WDV. So when it is a new asset, you're going to do it on cost. When it is an existing asset, you're going to do it on return down value, the return down value. So you need to know these two concepts to understand the depreciation. Because here we said, when we saw this multiple choice question, the cost was the opening balance, that is the WDV was 7.5 lakhs. This was the cost, right? So now, is it that straightforward? Is it that straightforward and simple? But there are some exceptions, or there are some rules where your cost will be different from what is the actual cost. So please, let's go into the session to understand what is cost in accordance to Income Tax Act. So when we say this, we have to go to a definition section. PGBP as a definition section. What section is that? You need to remember the story that I was talking about. Every act generally has a common definition section, that is section 2. But in Income Tax Act, apart from the common definition, now and then in that respective chapters, you will have a respective definition section. So similarly, for PGBP, the section number is what? The section number is 43. Where did we see this? When we said 43, we discussed about other definitions like speculative business is discussed in your section 43. So we discussed that certain key terms, the meaning of plant, the meaning of what you call, was discussed in 43, right? So section 43 is a definition section which gives you various definitions. So in that 43 clause 1 gives you the definition of actual cost, okay? Actual cost. So we are going to discuss about actual cost in this particular slide. The actual cost of the asset, actual cost of the assets to the assessee. So what is the actual cost? Whatever is the actual cost to the assessee. So whosoever is currently owning the asset, whatever he has spent money, whatever this assessee has spent is what the actual cost is. But if there is something which has been met directly or indirectly by any person or authority, what does this mean? Let's say I am buying a machinery, okay? Machinery of 10 lakhs. Now, out of this 10 lakhs, my cost is actually not 10 lakhs because government says I am giving you a compensation. I'm giving you a compensation for purchasing this machinery. So out of 10 lakhs, I'll give you 2 lakhs. So which means 8 lakhs only my actual cost, because 2 lakhs is not spent by me. It is directly or indirectly spent by some other authority, not by me. We are not talking about loan and all. Why are we not talking about loan? Because loan is repaid. So it is still my cost. I'm not repaying it. I'm not paying it today, but I'm going to pay it over a period. So it's not about, when you say other authority, it's not loan transactions. It is about where the cost, the entire portion of cost is not yours. So it's something like contributed by someone from like government or any other authority who's giving you back some money of that particular asset. So please remember, the actual cost of the asset is the cost to the assessee. It must be reduced to the extent where such cost is met directly or indirectly by any other person or authority. Clear? So that's a straightforward definition. When you talk about this section 43, we also have to understand another section called 40A, which tells you that when you are taking 40A, okay, 40A is basically, it is inadmissible deduction under certain circumstances, not always under certain circumstances. So one such expenditure is cash payments. So if you are making a payment more than 10,000 to a person in a day, that expenditure is not allowed. That expenditure is not an allowed expenditure. So even for fixed asset, if you are purchasing in cash, the asset value is more than 10,000. If you have paid it in cash to that person, that cost should not be considered as a fixed asset. So please remember, let's take, I'm buying a laptop. Let's say I'm buying laptop, two numbers. Let's say the cost is 1,50,000 for two laptops. That is, let's say one was 60,000, another is 90,000. Now this is paid by bank, through bank, and this by cash. Okay, so this is not an eligible asset. I am not eligible to claim this as a cost of my asset. So which means I cannot take this into consideration. I cannot claim depreciation on this. So I can only consider on this particular asset. So that's what we are actually calling it by whatever is paid towards. So exclude the cost incurred in excess of 10,000 to a person in a day, other than by account pay check drawn on a bank or whatever. It could also be paid through prescribed electronic mode. We are all very familiar with this term right now, because right from a very small business like tender coconut to a tea shop to any shop, be it any shops that you go, this mode is accepted. Regular modes that we are actually paying. What are these? Credit cards, your net banking, and these days these are very common, right? UPI, BIM. So wherever we go, we just take our phone, we just scan it and pay it again. So we are very used to these payments these days. From the time of demonetization, for the last couple of years or little more than that, we are very used to this payment method. So that is, so income tax has amended, apart from credit card, debit card, and net banking, they have started including payments like UPI and BIM into prescribed electronic mode. So this prescribed electronic mode is all the modes that we are generally operating, that is we, parents, friends. So some one of them will be regularly knowing for using these methods on a day-to-day basis for almost all the transactions in a day. So this is what you say. So payment allowed is only through prescribed payment mode, that is an account pay check or prescribed electronic mode. Everything else is not allowed. Anyways, we'll see this 40A3 a little detail. So any questions on 40A3, reserve it for now. We will discuss it at later point in time when you're actually discussing 48 clause 3. So for now, what should you remember? You should remember that the actual cost of the asset to the assessee is what the cost is. It must be reduced to the extent what is being contributed by any other authority. And to the extent that it is paid in cash for more than 10,000 to a person in a day should be excluded. So this is the general definition of cost. Okay. Now I'll try to take some questions or whatever has been discussed so far, and then we'll move on to then other exceptions. There are some exceptions to this concept of actual cost. We'll see that from the next slide. Okay. Anand, or net profits from companies are classified as income under PGBP. Yes. So when you say PGBP, it is not the income that when you say the income, it is typically income minus expenditure, because it is the net receipt that is taxable, not the gross receipt. So when you say net profits, net profit is the one which is basically covered under PGBP after making adjustments, whatever we are seeing now, like additional depreciation, whatever is not there in your accounting, whatever is there in income tax. So whatever has to be disallowed, whatever has to be allowed, whatever has to be additionally provided. So all that adjustments are made. So net profit, adjustments made, give you the income under PGBP. So that's what we discussed in section 29, the structure. Arshit, explain material 4182 example 1. I'll try to go through that in the break and see what exactly it is. Abdul, I made my notes from it. It's okay. Yeah, it is completely fine. Many of you have answered correctly. Almost all of you have answered exactly the answer. Brightness to see my face. I think the problem is with my skin color. I don't know whether the problem is with the light. Anyways, I'll try to see if I can make some adjustments. I'll try to see next time. Yeah. Power generation undertakings cannot change depreciation method once it is up. Yeah, they can opt it only in the first year. They are generally eligible for straight line method, but in the first year, if they want, they can choose WDV. Subhashis, the key man insurance policy, will it be taxed twice? We'll put it this way. Whenever it is received from the company, it is taxable in the hands of the company. But when you're actually giving it to an employee, it is not, again, not taxable. What is taxable to the employee is what is being directly given to the employee. The premium which is being paid for the employee will be considered as a perquisite in the hands of the employee. So whatever is subsequently given will not be taxable. It is only taxable once. If it is directly received by the company, it is taxable in the hands of the company itself. Dhyanish, terminal depreciation, we'll see that in this particular session. Arshid, partly made by cash, partly made by bank. What is paid in cash alone is not allowed. What is paid in cash alone is not allowed. So if you're making a payment of more than 10,000 in cash, that proportion alone will not be allowed. Let's say in 60,000 laptop, you have paid 40,000 in cash, 40,000 alone will not be allowed. Dhyanesh, if he has capitalized GST, can he claim depreciation? Yes, he can claim. But of course, you're still eligible for GST input tax credit from assets. But in case if you have capitalized it and you're not taking credit, you're eligible for depreciation because it is not contributed by another authority. Even the GST amount, if it is contributed by some other, which means if you're taking credit, it means it is contributed by some other authority, so it must be reduced. So even any taxes, if it is being refunded back to you, that should not be included in the cost. If it is not being refunded, which means if you are not taking GST credit, it will be part of your cost and you can claim depreciation. What is appendix? Dhyanesh, probably I think I did not understand your question. Have I used that word somewhere? But generally, appendix is like an annexure, but I don't know where exactly I have used it in the discussion. Okay, so with that, we will go to the next slide. So we'll go to the exceptions. So we understood what generally cost is. Now we are going to go into the exceptions of where all the cost is slightly different from the actual cost. So the first thing that we are going to discuss about, which was used for scientific research, but currently it is used in other business. It is being moved from scientific research business to other business. So how do you determine the cost? So typically the scientific research, you are eligible for 100% deduction. You're eligible for 100% deduction, like your 35 AD. You are eligible for 100% deduction for expenditure made on scientific research. I am forced to use this word quite often. This scientific research also, we will discuss it a little later. What is the scientific research? For time being, we'll understand the scientific research is any expenditure for conducting this research on science. So that for that business or for that payment, there is a 100% deduction, even if it is capital asset. So now let's assume you have already taken a credit, that is, you have taken 100% deduction on that asset. Now, currently, you are moving that asset from the scientific research business to another business. So there must be a cost to this. What you do is you take the cost minus depreciation minus any deduction allowed under 35, what has already been allowed. So which means, let's say the cost is 100, the deduction already provided is also 100, the cost will become 0, correct? The cost will become 100. If this is not 100, this is 80, the cost will be 20, correct? So typically, actual cost minus whatever has already been claimed as deduction. You cannot consider it twice, right? So you can only claim once. So you have already claimed 100 rupees earlier. You are not eligible to treat that as a cost again. So that is not allowed. Simple reason, then it will be like a double deduction allowed, double claim allowed to the assessee. So it's not allowed. Please remember the reason why a provision is made. When you talk about provisions, you can always remember why that is in existence. There will be a logical explanation, a reasonable explanation on why such provision was introduced. So in that case, if you actually look at it, this expenditure has already been claimed as deduction, which means you have claimed it 100%. So how can you again claim depreciation on that? So that is why we say actual cost minus what has already been allowed under section 35(1)(4). We'll see this section 35 a little later because we are currently discussing about the concept of depreciation. So when we go to section 35, we will see how much is allowed as a deduction. How much is allowed as a deduction. For now, what we understand, if the cost is 100, if the deduction is 80, your actual cost will be 20. Okay, clear. The next explanation. So all this EXP is called as explanation. So in provisions, you have this concept of explanation, which basically provides additional clarification or additional information on the provision. So 43(1) is actual cost. These explanation provides additional information or additional clarification on how actual cost must be arrived in various circumstances. So explanation in Income Tax Act in a section refers to additional information or a clarification provided. So that's what it is about. Okay, coming to this explanation 2, it is an asset acquired by the assessee, but by way of gift or inheritance. Okay, so it is being acquired by gift or inheritance. How do you do that? So it's typically very simple. You take whatever the actual cost to the previous owner, which means the previous owner of that asset, whatever was the previous asset should be taken. Please remember, it is only for gift or inheritance. It is gift or inheritance. It is not for anything else. So let's say the cost of the previous owner is 100. Okay. Now he has been having it for, let's say, 5 years. Now you provide depreciation for 5 years. So 5-year depreciation, you provide 5-year depreciation, and the difference will be the actual cost. Okay, so the difference amount will be the actual cost. So 100 minus 5 years depreciation will be your actual cost, because it has come by way of gift or inheritance. So which means it was not used for business earlier. So whatever you are taking right now is basically first time bringing into business. So you have to provide depreciation as if you are using that asset, Clear? So that is explanation 2. Okay. So we'll move on to the next explanation, that is explanation 1A, where it is an inventory converted into capital asset. Can we just go back, rewind back and understand something that we discussed in the last session on PGBP? It is basically, we discussed about something called conversion of stock into capital asset, right? Stock into capital asset. If you actually remember that, in section 28, what did we say will be the income? What amount will be considered as an income, correct? We discussed about a particular concept, and one of you questioned on how will you arrive that number also. We discussed about a concept called fair market value. So what will be treated as your income? Of that conversion of stock into capital asset will be your fair market value. What did we say? One of you questioned on what will be considered as fair market value. I said, if it is an immovable property, it will be a stamp duty value, that is registration value. If it is any other property, basically a value which is available in the market. For that, one of you questioned, what if there are no competitors? To that particular product? Which means the product must be valued in some mechanism that will be discussed with you in the final. There is a method when you are covering final little down the line. You will understand how this fair market value be arrived for various assets. For intermediate, you just remember it is fair market value, and you remember that fair market value is a value which is available in the market, which is generally available in the market. That is the usual price. We also discussed about a general purchase. You go and purchase a phone, whatever is there in the retail price in that store is basically your fair market value. So now the fair market value on the date of conversion. So there, that will be treated as an income. This conversion amount, if it, let's say 10 lakhs, This 10 lakhs will be considered as an income under section 28 and it will be treated as a cost, asset, fixed asset cost in your books of accounts. So this 10 lakhs will be the value. You will provide depreciation on this 10 lakhs from this year. From this year, you will provide depreciation on that thing. So that's what it is about. So it is the fair market value is what will be considered as the income and the fixed asset value. Okay. The next explanation is explanation by, which is on building. Okay. In explanation 2, we saw when an asset is being gifted or inherited by will, right? So this is the explanation 2. Explanation 5 is basically for buildings alone, which is previously owned by an assessee, but it does not talk about, it is previously owned by the assessee, but it does not talk about any other asset. It is only for building. Okay, please remember this, it is only for building. So what will be the actual cost? Actual cost to the assessee minus depreciation allowed as if it is used for business. Now, can you easily compare this with explanation 2 and 5? If you see explanation 2 and 5 have same method. So what did 2 say? Take the actual cost minus depreciation for the rest of the year, right? For the rest of the years. Similarly, here also the cost minus depreciation till date. So we discussed in the previous slide. That it is actual cost minus the depreciation till date. Same concept. So you need not remember the provision several times. Same provision is applicable for explanation 2 and explanation 5. Same provision. So what does explanation 5 say? Same thing. Take the actual cost to the assessee, then minus depreciation till the date it is being provided. So that is explanation 5. When we are talking about this explanation, some of you who are actually having material in hand and going through the explanations that I'm currently explaining, please understand, I am skipping like a couple of explanation, which is, I feel it is definitely not relevant. I can just give you a heads up. I've skipped like 3 explanations in between. It is definitely not relevant. So whatever we are discussing right now, that 3 explanation is relevant for your final. So whatever we are discussing now is relating to your intermediate. So this explanation 5 is what we have covered after 2. So 1A, 2, and then we have jumped to 5. We have skipped out 3, 4, and 4A. So illustration 2, a car is being purchased by Dr. Soman. A car is being purchased by Dr. Soman on 10th August 2019 for 5,25,000. So he has purchased it for 5,25,000 for personal use. He is using it for personal use. Then subsequently on 1st July 2022, by him, when its market value was 2.5 lakhs. So the market value on that date is 2.5 lakhs. So he has taken that car on this date. So now we need to compute the actual cost and the amount of depreciation as if the depreciation rate is going to be 15%. Most of your questions will generally give you this depreciation rate in the question itself. So you may not require to be remembering the depreciation rate, but it's always good to remember the key assets alone. If you remember, we discussed about the key assets depreciation rate in the previous session. Remember that alone. The rest of them, mostly you will not be questioned. Even if questioned, I think you'll be given the depreciation rate. So you can you can openly remember only the important assets depreciation rate. Okay. So that is your 15% is the rate. So now what is the actual cost? So what is 43.1 says? Straight away it says cost to the assessee. Cost to assessee. Right? Actual cost. Okay, I'll also add that word. Whatever is the actual cost to the assessee should be considered. In some of the explanations we saw, for example, explanation 2, we said asset by gift or will, correct? So by gift or will, you are getting that asset where you say actual cost minus depreciation till date. Same way in explanation 5, we said building previously owned by someone. Okay, someone. So there you say take the actual cost minus whatever depreciation is allowed. But there are no deviation for any other assets. No deviation for any other asset. Now this asset, is basically he was using for personal use. Currently, is bringing into business use. So here, what will be the cost? It is not gift. It is not inheritance. It is not building transferred from personal use to business. It is some other asset. So which means what will apply? What will apply is this provision only. So what will apply is basically this provision where it says what? Actual cost to the assessee. What is the actual cost to the assessee here? It is 5,25,000. So the cost in this question is basically 5,25,000. 5,25,000. It was purchased in 1st July 2022, which means it's more than 180 days. So you straight away apply 15%. So this will be your depreciation for the assessment year 23-24. Clear? So that's, please remember the point here in this question is when it is being previously used by the assessee, subsequently continued for the business purpose, the depreciation for earlier years must be reduced only for building, because that's what explanation 5 says. And similarly, explanation 2 is only where it is coming as gift or will. So the assessee itself is different, father, son, or whatever it is. But here it is about same person, personal use, business use, not building, not building. You'll have to take the original cost because that is what 43.1 says. Please remember this. It is a very, what you call, very important understanding for as far as this 43 clause 1 is concerned. Okay, we'll move on to the next explanation, explanation 8. It is about capitalization of interest cost. Okay, so typically when you buy a loan, when you buy a property, you might buy it on loan. Okay, let's say what we will say that we'll take an thing. Let's say I am buying a machinery. I'm buying a machinery. Let's say the machinery cost is 10 lakhs. Now I have taken this on loan. Loan amount is, let's say, 8 lakhs. Okay, and interest in previous year 22-23, let's say it is 1,50,000, and the machinery purchased needs to be installed, and set up. So the installation is generally taking, let's say the machinery was purchased on 10th April 22. Okay, 10th April 22. Now this asset, this machinery needs to be constructed, needs to be installed, constructed and installed. So this is taking like close to what, 5 months time. So typically by 31st August, it is ready for use. Okay. Now this interest should be split into till August, and this is balance. Okay. So let's say till August it was 80,000, and then it is 70K. Now the cost of the asset, will be 10 lakh plus 80,000, because this interest cost till it is ready for use, must be capitalized. This 70,000 will go to P&L. This 70,000 will go to P&L. So whatever needs to be capitalized is this 80,000. So this is capitalized. Clear? So this is what explanation 8 says. Interest is connection with the acquisition of asset relatable to any period after that asset is put to use, shall not be included and shall be deemed to have never been included in the actual cost of such asset. So typically, till it is put to use, it is capitalization. After it is put to use, it shall never be included. It comes into P&L. So that's explanation 8. And explanation 9 is about any credit. We spoke about GST, input tax credit, or customs, or whatever. If you're getting the credit on which credit is claimed, it shall be reduced. It's something like what 43 clause 1 says. It says reduce the amount which is being met by some other authority, correct? So when the duty is refunded or duty is taken credit of, which means that proportion is like contributed by the government itself. So that proportion should not be included. So that's why the actual cost must be reduced. So any taxes on which you're taking credit on that asset needs to be reduced, because it is something like given to you by some other authority. So that's why it has to be taken. I think Dhyanesh question, what will happen if GST credit is not taken? Of course, when credit is not taken, it should be, the whole should be, amount should be considered as cost. If credit is taken, then it must be reduced. That's why the word is credit is claimed. So only when claimed, you need to reduce it. Okay. So that's what explanation 9 is about. Okay. Now, the next explanation is subsidy grant reinvestment. We already discussed this. So whatever subsidy or grant or any amount given by government or any other authority should be reduced from the asset value. So basically, subsidy are provided by the asset acquired by the central government, state government, or any authority. Please remember, it could be anyone. Established by any law or any other person shall not be included, or any other person also shall not be included. So it shall not be included in the cost. So whatever you are claiming as subsidy, grant, or reimbursement should be reduced from the asset. That's straightforward. But please understand the next concept. Okay. Next concept. What does it say? But the benefit cannot be directly relatable to the asset acquired, the proportionate subsidy or grant shall not be included in the actual cost. So now let's say there is a subsidy which is partly for asset, partly for something else. So you're here, you do not know how much is it for asset, how much is it for something else. In this case, you take the proportion. You take the proportion of the cost and consider it. So that's what it is there. Okay. So now let's say there was first asset 10 lakhs. Second asset 7,50,000. Now for this put together, you are getting a refund of let's say what we'll take it as 3 lakhs. 3 lakh is the grant. So now you are getting back 3 lakhs for what? 17.5 lakhs. You don't know how much relates to 10 lakh, how much relates to 7.5 lakhs. So what do you do? For 10, you take the proportion of 3 divided by 17.5 into 10. For 7.5, what do? You take 3 divided by 17.5 into 7.5. Clear? So this is how you compute and say how much is for 10 lakhs, how much is for 75 lakhs. So that's what they say. When it is not directly relatable, you will have to take the proportionate. Clear? If you see, most of the provision is very logical, right? So you need not actually even remember it. So moment someone tells you that I don't know how much is for this asset, but I have received grant for 3 assets, you know that it has to be in proportion. No one needs to probably tell you also. That's the concept of these provisions. So they are straightforward. They only are put in place to achieve the objective. So what is the objective here? Every asset should be reduced with a required proportion. So that's the objective. So it automatically, you know that it is proportional when it is not identifiable on an individual manner. Correct? Okay. Now the next concept is, what if an asset is acquired by which was earlier used by a non-resident outside India. So it is earlier used outside India. For this also, what same procedure? Like explanation 2, like explanation 5, explanation 11. For all three, what is the process? Take the actual cost to the assessee minus depreciation till date, minus depreciation allowed till date. So same concept. Explanation 2, what was it? You are receiving the asset by gift or inheritance or by will. So that is explanation 2. What is explanation 5? It is building owned by the previously owned for personal use. That is explanation 5. So now what is explanation 11? It is a non-resident. It is acquired outside India by non-resident. So it was purchased by a non-resident. Now it is being brought into India. How do you treat it in India? So that's what it is about. So an used asset purchased by a non-resident is being brought into India. So now what happens? Again, it is same concept. Actual cost minus whatever depreciation is allowed. Clear? Okay, the next concept acquired during the previous year. So now we are moving on to the next concept. So so far whatever we have covered is the actual cost, right? So when you say actual cost, what did we say? We said generally it is actual cost to the assessee, and we only have to exclude two things. One, to the extent shared by other authorities. Next is whatever is being made by non-prescribed modes, that is in cash, more than 10,000 should also be not allowed. So these are the things that needs to be reduced from the actual cost. We saw various explanation here. We discussed about explanation 1, that is on scientific research, 2 on gift or will, 1A on inventory to capital asset, 5 is on building previously owned, and then we discussed 8, which is capitalization of interest, and 9 is on credit claimed, right? Credit claimed on your customs or excise duty. 10 is on subsidy, grant or reimbursements, and finally 11 on purchase by non-resident is now brought into India. So we saw relationship also. For example, for explanation 2, 5, and 11, the concept is same. Cost of the asset owned by the assessee minus depreciation till date. So these are the three things similar. 2, 5, and 11. 2, 5, and 11. So these are the common things. So now what do you do? So typically whatever you do is these explanation is what gives you a different cost from the actual cost of 43.1. So all this needs to be considered. So now apart from this, we will now move on to the second concept of written down value after addressing some of the questions on this actual cost. Anand, how is depreciation of an asset related to expenses such as salaries? Okay, now let's take this as an example. You are building an asset and some person of your company is involved in building that asset. You are spending salary, you are paying salary to them. To the extent it is for building that asset needs to be capitalized. So whatever is the cost that needs to be put to use. However, there is no specific explanation here. Typically, whatever the actual cost to the assessee refers to whatever cost is attributed to bringing that asset to ready to use stage. So it's typical to what your accounting standards is prescribed for arriving at the cost of fixed asset, where it says that the cost till it is put to use, whatever cost is incurred. So in that case, it is also there. Mohammed, what if the expenditure is 9,999? It is allowed because it is not crossed 10,000. So it does not exceed 10,000. So up to 10,000, it is okay. 10,001 is not okay. 10,000 is okay. 10,001 is not okay. Okay, Shruti, what is the difference between actual cost 20 and actual cost 100? I think I wrote it in one of the explanation. Yeah. So typically, for scientific research, for the scientific research, typically you are allowed for 100% deduction on capital asset. Okay, on capital asset. So this is what is the general provision. So now if I purchase, let's say, a machinery, okay, a lab, machinery for the lab, which cost 5 lakhs. I have purchased this in, let's say, June 20. Okay, so I would have claimed 100% in previous year 2021, correct? I would have claimed the deduction in previous year 2021. So now, subsequently, in previous year 22-23, if I am using this machinery for non-scientific research, business, I must bring that asset with the cost. So what it says is the actual cost, that is what you're going to identify. You are going to identify the cost, okay? You're going to identify the cost, or we'll just use the word cost. The cost is equal to actual cost minus deduction under section 35. Deduction under section 35. So what is my actual cost here? It is 100. Deduction is 100. So my cost will be 0. What if this is not 100, this is 80? In that case, my actual cost will be 20. So this is why I said, so the wherever I've used this concept of actual cost here and actual cost here, we are arriving the cost. We are arriving. So this is arriving cost. Whatever you are arriving as an actual cost. For that, you take the cost incurred by the assessee. So that's what I have discussed in this example. Hope after this example, you would have been cleared in what I'm trying to explain. Geet, what will be the actual cost used for? See, the actual cost is for depreciation, right? So on any new asset, the depreciation will be cost into rate, correct? So now what is the cost? So that's what we are identifying. The cost is what you have actually incurred. If I'm purchasing a new asset, whatever money I have given, that is my cost. Now, what all are the exclusions or different way of arriving at cost in various circumstances? That's what we discussed. For example, we discussed about explanation 1 on scientific research, 2 on getting the asset on gift or inheritance or will. 1A is on stock into capital asset. So in these cases, what will be the actual cost? What will be the actual cost? So that's what we are discussing. Abdul, but in explanation 2, given that actual cost to previous owner. Actual cost to previous owner is basically, this previous owner is typically nothing but, I have 2 business, okay? 2 business. One is scientific research, 2 is non-scientific. So when you say previous owner, this is the previous owner. So same assessee, but held by different business. So that's what you are saying. So it's basically actual cost will to the extent whatever. So that is for scientific research. Here in this case of previous owner, it's typically when you inherit, okay, gift, will or inheritance. So in this case, it will be like father, son or daughter, correct? So the cost taken will be this person's cost minus depreciation till date. So that's what is discussed in 2, 5 and 11. So 2, 5 and 11 says whatever is the cost to the previous owner should be the father, son, or in case of 5 and 11, the original time when the assessee has purchased. So that's what it is about. Pranav, what is the use of explanation 5? As the building is not with the business now. Building was for personal use earlier. Please remember, it was previously owned for personal use, currently used for business. So previously owned for personal use, currently owned for business. So this is personal. So that is minus reduced with the depreciation. Actual cost, Rahul, yeah. In kind of section, explanation 2, 5 and 11, it is the WDV to the current assessee. WDV to the current assessee is what should be considered. Abdul, if grant is given by other authority to NGO for purchasing asset, yeah. Whatever you received, you need not wait till NGO publishes it somewhere and all. Moment an NGO gives you a grant, you need to reduce it part of the asset. For example, they are helping you setting up some water RO machineries in a factory. Whatever the cost needs to be. So typically, you need not wait till someone publishes and all. Moment someone has contributed, you will have to go again and deduct. So There is no other requirement for that. Muhammad, I think I have answered your question of cash expenditure. I think some of you have a doubt whether your question is actually appearing here or not. It does appear. So I will try to take up most of the questions also, definitely. What is required outside India by resident? Then, Geet, whatever, if the asset is acquired by a resident outside India, then the concept of this does not come. So typically, this does not come, right? So whatever is the actual cost that he purchased outside India needs to be considered. Similar to this illustration too. Whatever he purchased earlier, what we consider as only 5,25,000. So that has to be considered as a cost. And probably the reason why the resident is not discussed here in explanation 11 is because if you are a resident, you are eligible to disclose that business here in India and keep claiming depreciation, right? If you're a resident, that business income is taxable in India also. Even if the business is outside India, that business is taxable in India, which means you would have already been giving depreciation. So no need to do any recalculation as that. So that's why probably resident is excluded. So Geet, I think I've answered your question. Muhammad, in 40A3, only the cost that is above 10,000, which is being paid. That is, as I told you, if it's a 60,000 asset, 40,000 is paid in cash, 40,000 will be ignored, 20,000 can still be considered. Subsidy grant shall not be included in the actual cost as deduct from the cost of the asset. That's what. See, it's the same. Actual cost will be reduced from the asset. So whatever is the subsidy will be reduced. So Anand, whatever is the subsidy will be reduced from the actual cost of the asset. Mark, what if used for scientific research for 1 year then received as gift by assessee? See, gift is not possible in business, okay? Your business can never gift. Gift is only personal. Gift can never be business. So that can never happen unless you are gifting it to an employee. In that case, you will treat it as an perquisite in the hands of the employee. So there is no gift in the hands of business. So that can never happen. Nikita, explanation 8, that is capitalization of interest. I think I drew a diagram, I explained it. Yeah. So we'll take this as an example. Machinery was purchased on this is for explanation 8, since Nikita wanted to be explained it again. So 10 lakh is purchased on 10th April 2022. So that asset is machinery is being purchased, but it needs to be installed. It is installed only on 31st August 2022. It is purchased through loan. Now this loan during that year, between April 22 and March 23, you have incurred an interest of 1.5 lakhs. Now this 1.5 lakhs needs to be split between till August 2022 and the balance period. Whatever is till August 22 needs to be capitalized. Rest of the thing will be taken to P&L. So explanation 8 says whatever is the interest till the asset is put to use, reduce it from the asset. So in this case, 80,000. I'm sorry, I've used a wrong number. Yeah, correct. Plus, so 10 lakhs plus 80,000 will be your cost. Kavita, what is grant? It is something like subsidy only. When government gives, it's basically called as subsidy. Sometimes it's called as grant. So grant is basically exact concept like subsidy only. Just that it's a contribution for a project. Let's say that government says, if you are doing this project, I'll give you sum of 10 lakhs. You can purchase anything with that, any asset with that. So that is called grant. So it's basically given initially, first time itself. You spend money based on that. Subsidy is basically you get it later. More or less the subsidy and grant is same concept. It is given by government to encourage you to pursue something. Muqaddimah, this cash is paid 15,000, then amount is not included. Is 15,000, is 15,000. See, when you say more than 10,000, whatever is spent above 10,000 is excluded. So if you have spent 15,000, the 15,000 is excluded, not 5,000, not 5,000. So the question by Muhammad is in 40A3. I think I'll anyways discuss this in 40A3. So for time now, I'll not explain it a little more detail. If 15,000 is spent in cash, what will be reduced from the cost of asset is 15,000, not 5,000. Okay, with that, we have completed this 43.1, that is cost. We'll start with this, your explanation on WDV in the subsequent slide. Till that, we'll take a short break of 5 minutes or something, and then we will start continuing. So take a break and come back after 5-10 minutes. Yeah, thank you. Yeah. So welcome back after a short break of 10 minutes. So now, as we said, we have covered the actual cost of the asset. So now we are going to understand another concept, two terms. We said when we started the session, we said there are two terms that are very critical for depreciation, which is cost and WDV, because that only lets you know on what you will have to provide depreciation. So we understood the cost in detail. So now we are going to understand WDV, that is your written down value. So written down value is typically, as we said, income tax operates on WDV method, whereby you provide depreciation on written down value method. So let's not get into very theoretical, because you would have already studied the concept in 11th, 12th standard itself, whereby you say that you are eligible for this written down value method. So straight line method, written down value method concept. The concept you already know, you are very familiar with. So we will just see from the income tax perspective of view. So typically, when you say acquired during the previous year, written down value is nothing but the actual cost. Why do we still say WDV here? Because we'll see in the next slide, or probably we can cover that itself and come. Okay, we'll cover that and come. So how there is a template on how you need to compute depreciation. So typically, you take the WDV as on 1st April of previous year. So you take the opening WDV, in that you add actual cost to the assets. So whatever is basically you added, right? So this is A plus B. I've just put it as A minus B. It is A plus B. So you get total WDV, on which you added, and then you reduce whatever value you have received on sale of an asset, or demolished, destroyed, discarded, transfer, whatever you have done. If some asset is being transferred, the cost, the value for which you have received, that is, when you say money is receivable, it is basically the sale consideration of this asset. Then on that, you again reduce slump sales. What is slump sale? For intermediate purpose, for you, we will just understand that slump sale is selling a business as a whole. So whatever is the slump sale needs to be reduced. The cost of whatever you received on slump sale, that is also reduced. And then goodwill is no more an asset. So you reduce goodwill, whatever was there in the books till previous year 1920. With that, you get the WDV at the end of the year. WDV at the end of the year. You provide depreciation on WDV. You provide depreciation on that WDV, written down value method. That's why we say that this WDV is nothing but the actual cost for the assets acquired during the previous year. So typically, you will provide depreciation on the cost. In income tax terms, cost is added to the opening WDV to get the closing WDV. You provide depreciation on that only. So I think you should not confuse more on this. So typically, as we were seeing earlier, on opening WDV, you provide depreciation. On additions during the year also, you provide depreciation. So addition during the year is nothing but added to the opening WDV to arrive at the total WDV on which you provide depreciation. So in case if you are not understanding this concept, whatever you generally know earlier, keep that with you. That is perfectly fine for understanding purposes. So what is acquired before the previous year is typically actual cost minus depreciation till date. That's nothing but what? Written down value method. Written down value is nothing but actual cost minus depreciation till date. So that's how you compute your WDV. So with that WDV, what do? You compute depreciation for the year. You compute depreciation for each block or each asset, and then arrive at the total depreciation. So if you reduce that, you get the closing WDV of that year. For that relevant year, let's say 31st March 2023, you get the depreciation for that particular date. Okay. Now, when a particular asset was earlier exempt, let's say the business, not the asset, sorry, a business. I think you would have already covered the chapter exempt income. In exempt income, there is a section 10AA where you say that for SEZ business, you have tax deduction, tax exemption for, let's say, 10 years, correct? For 10 years. Now, this business is already exempt, which means the entire income from that business is exempt. So you would not have provided any depreciation or nothing of the kind because the entire income as such is exempt itself. So for such business, whatever is the book value, so for these assets, the book value will be the WDV. That is the net book value in your books of accounts will be considered as a WDV. So you need not recalculate as if you have provided in income tax and all. You straight away take whatever is there in the books, the WDV in your books, that becomes your WDV for the purpose of things. So that was there. So please understand, depreciation provided in the books. So whatever has already been provided in the books itself is as if it is provided in income tax itself, as if it is provided in income tax. So it is deemed to be allowed. So please understand that for exempt business, post exemption period from, let's say, for in 10A from the 11th year, whatever is the value that you're talking about in your books of accounts will be the depreciation, will be the WDV in the income tax purposes also. So that's what you're actually calling it as deemed to be allowed. And in some cases, depreciation will be reduced to be nil. WDV will be reduced to nil. In what cases? It's basically monies receivable exceed WDV. We were talking about monies receivable, which is nothing but sale consideration. So nothing but sale consideration. Let's say the block of assets value is WDV on 31st March. I will write it there. Let's say there are 2 cars, okay? 2 cars. So on 31st March 22, okay? 31st March 2022, the value of this is 4 lakhs. Okay. Now, in what is today's date? 17th November, right? 17th November 22, you're selling. Okay. So this is WDV. You're selling. Okay. You're selling 1 car. You're selling 1 car alone for 4,50,000. So now what is happening? Monies receivable exceed WDV. So in this table, what we saw earlier, we said less money is receivable. So in our question, what becomes? So in our question, what will happen? The opening WDV is 4 lakhs less money is receivable 4,50,000, which means it is minus 50,000. Correct? So WDV as on 31st March 23 will be minus 50,000. This is not allowed. So in this case, this should be considered 0. So that's what it says. It says whatever is the monies receivable exceed WDV, then you consider WDV as nil. The other situation is all assets. Now in the same example, 2 cars. So the opening WDV was 4 lakhs. Okay. Now on 17th November, I am selling both the cars. Here I am selling only 1 car. Okay. On 17th November, I sold 1 car for 4,50,000. Now I am selling both the cars put together for 3 lakhs. Now, technically my closing WDV is 1 lakh. But is this okay? Not okay? Not okay. Why? Because the entire block is sold. So there is no more block. So which means there is no more WDV. So in this case also, WDV will be 0 because all the assets are transferred. So these are the 2 situations where your WDV will be nil. Another concept similar to your exemption that we saw, it's 43 clause 6, we said explains about WDV, and there are explanations which provide clarification on computing WDV in various scenarios. One such scenario is situation of composite income. What is composite income? You have coffee, tea, rubber, whereby out of your entire proportion, only one proportion is business income, the rest of the proportion is agriculture income, which means it is exempt. The agriculture income portion is exempt. For example, in tea business, 60% is agriculture income, 40% is taxable under PGBP, correct? So 60-40, 40 is income. So for these kind of business, income tax says compute whole depreciation. Don't compute 60-40 first. Compute the total tax, whatever is supposed to be your total income, compute that after providing depreciation also. On that, you calculate 60 and 40. So if you need to take this example, let's say 20 lakh is the turnover, depreciation is 1 lakh, other expense is 5 lakhs. Now, so your turnover is 20 less expense, right? So depreciation of 1 lakh, other expense of 4 lakhs. So 15 lakhs, correct? So on this 15 lakhs, you divide it into 60-40 ratio. 60-40 ratio. So on 15 lakhs, 40% is what? 40% is 6 lakhs. So 6 lakh is your business income, whereas your 9 lakh is agriculture income. So this 6 lakhs alone now will be treated as business income. Depreciation is total 1 lakh. So you need not compute separately for what is 40% and what is 60%. So the depreciation is so computed, that is the entire 1 lakh shall be allowed to the assessee. So the entire 1 lakh is allowed to the assessee. It's not 40,000 or 60,000. So it's not 40,000 or 60,000. The entire 1 lakh is already allowed. So that's what we need to remember in composite business. So for composite business, compute final taxable income after providing all expenses, the entire depreciation on that total income, on that total business income, compute 60-40 or the relevant ratio as 70-30 or 80-20, depending upon the business. So whatever is this is called the treatment for composite income. So with that, we conclude depreciation. We only have one thing to discuss about depreciation, about what happens if you have unabsorbed depreciation. It is basically, what is unabsorbed depreciation? Let's take an example. We'll take an example for unabsorbed depreciation. Okay. Now let's say my PGBP income. Okay, I'll start from here. Let's say my profit from the books of accounts is 5 lakhs. Okay. On this, generally, I have to allow depreciation only to the extent of income tax act. So what I will do is I will add depreciation for the books. Okay. So whatever depreciation has been provided in the books, depreciation provided in the books will be disallowed. Let's say the depreciation provided in books is 4 lakhs. Okay. So now my profit is 1 lakh. Now in this, I need to less depreciation per section 32. Let's say the depreciation is 4,50,000. Correct. Now, if I actually less 1 lakh, I get a loss of 3,50,000. I get a loss of 3 lakh, sorry, 9. I'm really sorry. I've got the numbers wrong. So here, in this case, it is profit, correct? 4,50,000 is your profit per income tax act. You tax this. Now, in some scenarios, what will happen is it might end in a loss. Okay, it might end in a loss. So I'll give another number to start afresh for loss. Now my profit here is 1 lakh. Okay, my depreciation per book is 4 lakhs. So totally 5 lakhs is my profit. So I add this, correct? I less depreciation per act, that is section 32. Now what is my depreciation? Let's say it is 5,50,000. Now I have a loss of 50,000, correct? Loss. Now, the reason for this loss is my depreciation, correct? Only because of depreciation, I am making a loss. Because as per books of account, my profit is 1 lakh. But as per income tax, I have a loss of 50,000. Why have I had this loss? Because of depreciation. So now this 50,000 will be called as unabsorbed depreciation. So if I have a depreciation amount which is more than my profit, so then what happens is it is called as unabsorbed depreciation. This unabsorbed depreciation is basically because it is not sufficient to give full effective depreciation allowance. So I cannot give more entire 5.5 lakhs. I can only give 5 lakhs. So this extra, this 50,000 which is not sufficient will be called as unabsorbed depreciation. Now this unabsorbed depreciation will be continued in the subsequent year and for the indefinitely. So till I have sufficient profit to adjust this 50,000, I'll continue to carry this 50,000. So there is no limit of number of years for carrying forward unabsorbed depreciation. Generally, a loss can be carried forward for 8 years or 4 years, depending upon the business. But this unabsorbed depreciation can be carried forward for n number of years. That is unlimited. So just that it is indefinite period. Considering that it is indefinite period, it will be the last in order of set off. So during the year, you will first set off current year depreciation. The subsequent year, if there is any brought forward loss, you set up that, and then any unabsorbed depreciation. So this is how you generally set off your depreciation losses. That is, unabsorbed depreciation will be set off in the manner: first, current year depreciation will be provided, then any brought forward losses, only the last preference will be given to unabsorbed depreciation. So this is how you set off depreciation. Okay. So basically the next thing, we'll see a problem. It's basically a newly qualified chartered accountant. It's a newly qualified. So it's the first year of business. Commence practice and acquired the following assets in his office during financial year 21-22. The cost shown against each asset. Calculate the depreciation for, of course, for you it will be, I think it will be 22-23 and assessment year 23-24. Assume that all the assets are purchased by way of account payee check. They have given date of acquisition, date of put to use. So what is relevant for depreciation is date put to use. What is relevant is date put to use. Please remember the relevant date will be put to use date and not acquisition date, because the asset only when it is ready for use, it is available for depreciation. Till that it is like capital work in progress. So now we need to see how many types of blocks are there. So you have a block called computer, then you have a block called books, and then you have office furniture and laptops. So typically the rate for computers is 40%. For books also it is 40%. For office furniture it is whatever acquired for practicing CA is also eligible for doing. Laptop is also eligible at 40%. Furniture at 10%. So these are the depreciation rate. The only thing we need to know is two things. Are they eligible for additional depreciation? No, right? Because they are not manufacturer. They are not in the business of power generation distribution. They are not in the business of printing and publishing. It's a chartered accountant business. They are not eligible for service industries. It's not eligible for additional depreciation. So only during their depreciation alone should be provided. Just that we need to know whether less than 180 days or more than 180 days. So 1st October is full depreciation. That is, it is more than 180 days because it has been purchased on 1st October. For your kind information, the date cutoff date for 180 days will be generally 3rd October. So any asset purchased after 4th October will be less than 180 days. So that's what it is about. Maybe you can do the math also. You can go and work out. Basically, it's 4th October is the cutoff date. 3rd October, 4th October. So after 4th October, whatever is being purchased after 4th October is less than 180 days. So 8th October is what put to use. So it is only eligible for a half depreciation. This is 1st October. Again, it is full. 1st April, full depreciation. 1st April, full year depreciation. And laptop is 8th October. So it is half year depreciation, correct? So this is what you do. So these assets, that is 1, 2, you provide half depreciation. For the rest of the asset, you provide full depreciation. I'm not going to work out this problem because it's straightforward. Applying the rate, the only critical thing here is we must know what is the rate, that is whether full or half of the year. So that's what is there. The relevant date for that is put to use and not acquisition date. So based on that, you decide whether it is for full year depreciation or half year depreciation and calculate it. We'll move on to the next problem. It's basically Gamma, a proprietor, started a business of manufacture of tires and tubes for motor vehicles. So what is keyword here? What is the keyword? As we start, we'll try to note whatever is the keyword. Business of manufacture is the keyword, okay, because they are into manufacturing. So what does that mean? They're eligible for additional depreciation. So on 1st January 2022, so they have started the business on 1st January, but the unit was set up only in 1st May. So which means it's the first year itself is only April 22, financial year 22-23. So he commenced manufacturing operations on 1st June 2022. Okay. The total cost of the plant and machinery installed in the unit is 120 crores. Okay, 120 crore. The said plant and machinery included second-hand machinery bought for 20 crore. 20 crore. The new plant and machinery for scientific research is 15 crore. Okay. So now what does this question say? It says compute depreciation under section 32 for assessment year, not 22-23, it is 23-24. So for 20-23-24, compute the depreciation. And they say that all assets are purchased by way of account pay check. And they also say that they have not opted for 115 BAC because it's an individual. Because Mr. Gamma is an individual, they have said they have not opted 115 BAC. Why is this important? You have not been covered. So what is this 115 BAC? Is basically called as a new tax regime. Okay. So what is allowed, what is not allowed will be discussed in your computations chapter. So basically 115 BAC is not opted. So I need not go into the provisions of 115 BAC. I'll have to look into the normal provision alone. So we'll just try to understand how this is worked out. So we'll have particulars. As we said, a note column or reference column. Then we'll have amount column. Okay. We can have a couple of amount column if you have an inner column. Otherwise, you can always have one amount column alone. Okay. So with this, we'll just start to understand the first thing. That is your what? We need to know normal depreciation, additional depreciation. They're in the business of manufacture, so they are eligible for additional depreciation. And it is already commenced operations on 1st June, set up on 1st May. So it is like more than 180 days. So it's more than 180 days. So the first is plant and machinery. Okay. On plant and machinery, we'll call it as normal depreciation. We'll write note 1 and then additional depreciation. Note 2. Okay. With this, let's say we get the total depreciation. Okay. Now, as a note 1 and note 2, okay, note 1 is to calculate normal depreciation. Okay. So there we say particulars. Amount. So basically total plant and machinery is 120. Less. For normal depreciation, what is not allowed is this 15 crore. This 15 crore for scientific research will be eligible for 100% deduction. So they are not eligible for depreciation because it is completely taken away. So scientific research, it is 15. So what is the total? It is 105. Okay, so 105 is the total. On this, you calculate depreciation at 15%. So on 105, you compute 15%. So what will it be? 15% is 15.75. So 15.75 is the your regular depreciation. So what about note 2, that is for additional depreciation? Again, I'll have particulars and amount. Okay, for additional depreciation, I'll take total plant and machinery, that is 120, less scientific research, that is 15, less second-hand machinery. So there is a second-hand machinery for which your additional depreciation is not allowed. So that is 120. So it's a second-hand machinery. So that is 20. So I reduce 20. So it's basically 35 is reduced. So 120 minus 35 will be what? 85, right? 85. On that depreciation at 20% for additional depreciation. So on 85, you compute 20%. So that is 17. So now here you go. One is 15.75, then 17. So 32.75. So this will be your total depreciation for the what period? For the assessment date 23. So they want to know, compute the depreciation alone. They don't want the WDV. If you want the WDV, probably you will have to say 120 minus this 32.75 will be your WDV, correct? So that's how you do it. Okay, with that, we complete the entire depreciation part of it. So I will just see if there's something to be answered in the question. When any one asset sold, how do we calculate WDV? Kavita. So basically, I think we discussed with 2 cars, right? Yeah. Okay. In this example, so this is when WDV is nil. Okay. In case if this is this value, let's say it is 3 lakhs. Okay. And the opening WDV is 4 lakhs. So what will happen is the cost here will be, the WDV will be $1 lakh, because I'm just reducing the monies receivable. So in general terms, if only one asset in the block is sold, it is opening WDV plus addition minus monies receivable, that is sold asset. So the template for WDV, will be opening WDV plus addition. Okay, addition minus sales sold. Okay, so you take the WDV, you take the cost, you reduce the monies receivable. What is monies receivable is the sale consideration, what you are supposed to receive. So that is what is supposed to be reduced. So this only will give you what? The closing WDV. On this, you provide depreciation. So this into depreciation only will give you depreciation for the year. Okay. So this is how you calculate WDV and depreciation if one asset is sold. Doshi, what is unabsorbed depreciation? As I told you, I think we'll go back to that example. Yeah. So my profit is 1 lakh. My profit is 1 lakh. My book depreciation is 4 lakhs. Okay. So which means my 1 lakh is after providing this book depreciation. What I need to provide is income tax depreciation. So I'll add my book depreciation, which means my profit is 5 lakhs now. I need to provide income tax depreciation now. Income tax depreciation is 5,50,000. So my income tax depreciation is more than my profits, So then the whatever is the not sufficient amount. So my 50,000 could not be adjusted because of additional unabsorbed depreciation. So this will be called as unabsorbed depreciation. Kavita, whether additional depreciation is always 20%? Yes. But we only said one condition. If it is less than 180 days, you provide 10% this year, balance 10% next year. So it is typically 20%. But if the asset is less than 180 days, 10% in year one and another 10% in year two. Dhyanesh, can I write note on my own words? Yeah, of course. See, whatever you understand, you can very well write. Probably in the slides, I have crystallized and summarized to the extent what is only relevant to you. So whatever is there in the slide is more crisp presentation of what is required to be understood. It's not the law. Whatever is module is to help you to understand it in detail to a complete understanding level. In the slide, it is given in a crisp, crystallized manner for you to refer. Something like recapitulate at the end of your chapter. So whatever you need to understand, you can do it through this slides. But to have a detailed presentation manner, it is always in the module. So read module and refer to the slides to understand the module. So that will help you better. Why wasn't scientific research asset not eligible for additional? It is eligible for normal, and it is not eligible for normal and additional depreciation because, as we said earlier, scientific research assets is eligible for 100% deduction. So the cost under section 43(1) will be nil because entire thing is already provided. So the cost of the asset will become nil. That is why we are reducing it here. Anyway, the next slide is only on scientific research. We'll try to understand the concept of scientific research. So I'll move back to the slides to continue the next area of understanding. It is scientific research. So scientific research is typically section 43. Clause 4 defines scientific research, right? So what does it say? Again, we are referring here to section 43. What is it? Definition section. So 43 clause 4 defines, clause 1 defines actual cost, clause 6 defines written down value, clause 4 defines your scientific research. So any activities for the extension of knowledge in the field of natural or applied science, including agriculture, animal husbandry, or fisheries. So if there is an activity on these areas, then it is called scientific research. So basically, whatever research done on science matters is called as scientific research. And when you talk about this expenditure, whatever activity, any expenditure on that activity will be eligible. So when you say any expenditure, the general understanding is all expenditure incurred for the prosecution of the provision of facilities does not include acquisition of rights. So please understand, any expenditure in conducting this activity, is called as scientific research. It's an eligible expenditure as scientific research, but it does not include acquisition of right. What do you mean by acquisition of right? Let's say I wanted to research about COVID. Okay, I wanted to research about COVID. Now, to start fresh from zero, it is very difficult. So now what I'm doing is, there is already an existing company who's doing research on this COVID related matters. So now I am buying that rights, whatever they have researched, I am buying that research and continuing my research from there. So this purchase cost of purchasing another person's research is not scientific research. So that's why it's highlighted. Scientific research expenditure does not include expenditure on acquisition of rights. So that's what it is about, scientific research. And similarly, this scientific research expenditure is an eligible expenditure only it is helping you in extension of business. For example, again, a medical industry doing a research on COVID will help them in extending their business, right? Will help them in extending their business. Currently, they don't have medicine for COVID. They're trying to find out a medicine and introduce it. So the research on this medicine for COVID is an extension of their existing business. So it is allowed. Similarly, it can also be in the medical nature, which has a special relation to the welfare of workers, or the research is related to the medical related matters that will benefit the workers. So it is either to extend their business or to support their welfare of the employees in the medical aspects. Only these two things is called as scientific research expenditure for their businesses. So for their own business, it will be called as a scientific research if they are spending for the extension of their business or welfare of employees relating to medical matters. Only this is called as scientific research expenditure for the purpose of business, So to understand scientific research relating to any activity relating to natural or applied sciences, including this agriculture, animal husbandry or fisheries, that is scientific research. So now expenditure on scientific research includes all expenditure, but excludes acquisition rights. Whatever has been paid towards acquisition right is excluded. So that is next category. The next thing that we need to understand is when it comes to business, the scientific research must be related to extension of your existing business or should be relating to the health related concern of the employees. So these two alone are considered as your scientific research. So now one more point that you need to understand, is preliminary expenses on scientific research. What do you mean by that? Preliminary expenses on scientific research. Preliminary expenses is basically expenses incurred before operation. That is, before this business commenced, you have been incurring some preliminary expenses. That is, prior to incorporation, prior to activity being commenced. So that expenditure is also allowed. On certain conditions. Let's see the condition. It says expenditure on scientific business incurred prior to commencement of business on payment of any salary or purchase of materials. So what are the expenditures that is allowed? Not all preliminary expenses, not rent, not nothing, only two expenditure. What are they? Salary, materials. Only these two expenditure are allowed even if it is incurred prior to commencement of business. But is that any number of years? No. Prior means 3 years immediately preceding the commencement of business. So if my business is commencing on 17th November 2022, 3 years before that, that is from 18th November 2019, 18th November 2019, correct? So that 3 years, whatever expenditure has been incurred on salary and purchase of material, only these two expenditure can be claimed as your preliminary expenses on scientific research. It shall be, that expenditure shall be deemed to have been expended in the previous year, which means, let's say, scientific research, 3 year period, 3 years prior to commencement, correct? So let's say the commencement is 17 November 2022. 3 years before will be 18th November 2019. So expenses between this period will be allowed. What expense? Salary, materials. Only these expenditure will be allowed. Now this expenditure, when can it be claimed? In the previous year in which business is commenced. When is the business commenced? 17th November 2022. So the previous year will be 2022-23. So your expense of salary and material for this 3 year period can be claimed in previous year 22-23. So that's what they call it as preliminary expenses. Correct? Okay. With that, we have understood what is scientific research, what kind of expenditure is not allowed And we have also understood what are all the nature of science, what should be the objective or benefit of that scientific research. Only then it will be called as scientific research for the purpose of your own business. Now, we also understood what happens to the preliminary expenses, 3-year expenditure. We also have discussed that. Now, moving on, we must understand how much is allowed, when is it allowed, right? So we must understand these. So to understand that, we are going to classify the scientific research into 3 buckets. We are going to classify it into 3 buckets. So what are the 3 buckets? The first one is incurred for my own business. I'm incurring for my own business. Okay, that's the first category. Second thing is it is paid to a company. So it's paid. Okay, so it is paid to a company, institution, or association. The third thing, third concept, third bucket is in-house research. In-house research and development, not being land and building. Not being land and building. So it is for in-house research and development. So first is for my own business. Second is I'm paying to a third party. Third is it is for my in-house research. So we understand these 3 independently. What do you mean by incurred for own business? What do you mean by payment to company? And everything we'll understand. So we'll first understand incurring for own business. Okay. When you say incurring for own business, 100% of the expenditure is claimed as deduction. 100% of expenditure is claimed as deduction, both revenue and capital. And when it comes to capital, what is not allowed? Land is not allowed. Land is not an allowed expenditure. So when you say incurred for own business, 100% of expenditure can be claimed, revenue and capital. Revenue will already been considered in P&L, correct? It would have been already considered as an expenditure in P&L, which means you need not do anything. But capital expenditure, you are allowing 100%. That's why we said in 43.1, cost of scientific research will be after reducing whatever you have claimed under section 35.1.4, correct? That's the reason. Once you claim 100%, the cost of the asset will become 0. So that's why we said the cost of the asset should be reduced by whatever has been claimed as deduction under section 35.1.4. Okay. So now this is what is for the own business. So what is that? 100% is allowed. Revenue expenditure probably would have already been provided P&L. When it comes to capital expenditure, you can additionally claim it as a deduction. 100% of that expenditure can be claimed. So that is first category. Now we move straight on to the third part. We said 3 buckets. The third bucket is basically in-house research and development, not being land and building. In the first category, you are only seeing land. Land is not allowed. In this category of in-house research, building is also not allowed. Building is also not allowed. Okay. Now, what is that? Is it eligible for everyone? Is it eligible for everyone? Is there any restriction? Yes. What are the eligible company? They must be in the business of biotechnology or manufacturing any product, production of any article or thing other than those mentioned in 11th schedule. Why is the government specifically excluding 11th schedule for research? Because 11th schedule is predominantly the items which are not good for the environment. Something like tobacco, alcohol, all these are covered under 11th schedule, which means it's not good for you or the society. So that manufacturing is not encouraged, So what is encouraged is only the manufacturing or production of any other article which is not covered in 11th schedule or in the business of biotechnology. So what is allowed? Capital expenditure. Capital expenditure, which is basically not being land and building. So which is not being land and building. So whatever is the capital expenditure, 100% and can be claimed. Only that is, it should not be land and building. Others are all allowed. So now the first bucket and third bucket is covered. So basically first is incurred for own business, 100% of revenue and capital expenditure allowed. When you say capital expenditure, land is not allowed. Similarly, when it comes to in-house research and development, again 100% can be claimed. provided they are in the business of biotechnology or manufacturing or producing any article other than the one prescribed under 11th schedule. For this also, they are eligible under 100%. Once a deduction is claimed here, no other deduction can be claimed under any other portions of that. So once it is claimed here, you cannot claim in any other portion. That's why depreciation is not allowed, right? Because you have already claimed the deduction here. So your depreciation cannot be claimed. That's why we say your cost becomes nil. So please remember, once a deduction is claimed here, you cannot claim any other expenditure or deduction under any other sections of this act. The second bucket, payment to another organization. So it could be paid to an Indian company with scientific research and development. Please remember, SRD is nothing but scientific research and development as the main object. So as a company, if I'm paying to another company whose main object itself is scientific research and development, only then I can provide a deduction. So that is whatever I'm paying is eligible as deduction. And if I'm paying to any university, college, or other institution or research association, it could be for social science or scientific research. Both are eligible for 100%. And next, national laboratory or an university of an Indian Institute of Technology. This is paid to these three institutions, then again 100%. So whatever amount is paid to another company with an object of scientific research development, any university or college in the research of social science or scientific research, and finally national laboratory or an university or an Indian Institute of Technology, which is also all this, whatever amount is being paid to them, 100% can be claimed as a deduction. So it can be claimed as an expenditure of entire expenditure can be claimed. So that's what it is about for scientific research. Here also no other deduction can be claimed under any other portions of the act. So this is all about scientific research. And when we say scientific research, the carry forward is exactly similar to unabsorbed depreciation, which means it can be carried forward for n number of years, unlimited number of years. And as far as the order of set off, this will have the last preference, because the first preference will be to the current year carry forward losses. So that will be the first preference. Similarly, no depreciation can be allowed under section 35 on which because deductions has been completely claimed. And sometimes what happens is I get 100% deduction, but subsequently I'm transferring it to my another business where I'm not at all using it. So which means I have claimed 100%. Now I am transferring it to another business. Which is not scientific research. So I am missing so if I'm actually transferring it without using, I'm transferring it for other purpose other than scientific research. What happens is your sale proceeds plus amount of deduction minus capital expenditure or amount of deduction, whichever is lower, will be taxable into the act. Such will be taxed even if business is no longer in existence. This formula might feel confused, right? Because it says plus amount of deduction minus the capital expenditure. Now we'll take a small example for this. Let's say I am a business of scientific research. Okay, I am in the business of scientific research. On 10th November 2020, I am investing 10 lakhs in machinery. Okay, so which means in that year, that is previous year 2021, I would have claimed 10 lakhs as deduction under section 35, correct? I would have claimed 10 lakhs as deduction, which means this is my cost of asset. Cost of asset is 0. Okay. Now, on 17th November 2022, I am transferring this asset. To another entity or whatever it is. Now, I could either sell it to another person or to my own business where I'm trying to use it. Now, if you actually remember it, I've already claimed 10 lakhs. I've already claimed 10 lakhs as deduction. So what they say is sale value plus deduction under section 35 minus my capex. Okay, let's say I am selling this asset for 3 lakhs. So sale is 3 lakhs. Deduction is how much under section 10 lakh 35 minus capital expenditure is 10 lakhs. So the net answer is 3 lakhs. Okay, then this or what do you mean? So this is sale based. Okay, sale based. Next is deduction. My deduction is how much? 10 lakhs. So whichever is lower is taxable under section is a deemed income. So which is lower? What is lower is 3 lakhs. So this 3 lakhs is taxable under PGBP because whatever I have receiving, I am taxing it in PGBP itself because I'm moving it to the other business without using it for the purpose. So I'm not using it for scientific research. I'm actually not selling it also. I'm giving it to just another business itself. So whatever I'm receiving, this is how I actually arrive at how much is taxable under the section 41. So that's also, this will be taxable under PGBP itself and it will not go to capital gain and all. So that's what it is about. And this will be taxable even if the business is no longer in existence. Clear? So that's about your scientific research. So that's all about scientific research. We'll take a small example on scientific research, which is basically paid to notified approved institution of science. So this is eligible. Amount paid to IIT for an approved, it is an eligible. Amount paid to X Limited, a company registered in India, which has its main object of scientific research and development. So it is allowed. So this is also allowed. So I can claim it. Expenditure incurred on in-house research and development facility as approved by the prescribed authority. Let's assume they are in the eligible business. Now, whatever is revenue expenditure on scientific research for my in-house, of course, I can claim it. It will come in my P&L itself, so nothing extra. But capital expenditure, including cost of acquisition of land, is 5 lakhs. So out of the 7,50,000, how much only will be allowed? How much will only be allowed for deduction? 2,50,000. Because for in-house research, both land and building is not allowed. For own business, land alone is not allowed. But for in-house research and facility, both land and building is not allowed. So after reducing 5 lakhs, only 2.5 lakhs will be eligible for exemption. So 1 lakh, 2.5 lakhs, that is 3.5, 7.5, 10.5 and plus 2.5. So this is only what is allowed. And this 3 lakh will already be allowed in P&L, so nothing needs to be done. So basically an additional deduction will only be 3.5, 7.5 and 2.5. That is totally 10 lakhs will be allowed as deduction. Clear? Okay, so we'll move on to the next section 35 AD. Before that, I'll answer some. Oh, Dhyanesh, you are asking notes for illustration, whatever you are writing below the problem. Yeah, you can of course use your own words. You need not follow what exactly is written in the module. 33, 34, as I told you, those tea, coffee, development reserve and all is not required. So basically you can go through the section. I'm trying to cover first whatever is more important and probably at the end of the time, I'll cover the rest of the sections. Commencement is basically Vajragiri. Commencement is basically the time in which manufacturing commences. So it's commencement of manufacturing operation. Pranav Vashishta is preliminary expenses can also allow yearly or not at first instance. No, it is not allowed yearly. It is allowed in the year in which business commenced. Salary and material will be allowed as business expenditure in the year of commencement of business, not in the year of incurring that expenditure. Kavita, why land is not included? It could probably be misused. Let's say I am having a business. Land is not a depreciable asset also, correct? So whatever I put into land is like a sunk cost. There is no depreciation, nothing is happening in the land. So which means, let's say I'm now saying I'm starting a scientific, I'm going to do a scientific research For that, I am buying a land. Now, whatever land is a sunk cost. I can't claim depreciation or something of that kind. If they are allowing me 100% deduction, it's like I'm claiming the entire benefit out of it. So land will be idle. It could be idle also. I do not know. So land, nothing, I will not be sure whether the entire expenditure on land is only for scientific research also. So basically, it could be misused. That's why we say land is not allowed. Under model 13 lakh, that's what I said. See, 10 plus this 3 is also actually allowed. See, what happens is scientific research, even revenue expenditure is allowed. But my point here, what I was trying to convey is it would have already been considered in P&L. So an additional treatment need not be done. So technically what happens in scientific research is, we'll tell you, let's say a profit is 5 lakhs. Out of this, 3 lakh would have been the revenue expenditure, correct? The illustration we saw. So I'm assuming this 5 lakhs, rest of the numbers. So now this 3 lakh revenue expenditure is already considered in this 5 lakhs, correct? So when I'm actually reducing capital expenditure is 10 lakhs. Capital expenditure 10 lakhs, which means I'll have a loss of 5 lakhs. Correct. So now this 3 lakh is already considered. Now what could be the other option is my profit is 5 lakhs. I add revenue expenditure of 3 lakhs. So my profit becomes 8 lakhs. I less scientific research. I less scientific research, how much? 13 lakhs. So my loss will again be 5 lakhs only, but in a different model. In both the cases, if you actually look at it, my loss is 5 lakhs. Just that here, I'm not doing anything to 3 lakhs. I'm just reducing 10 lakhs. Here, I've added the revenue expenditure of 3 lakhs. So the book answer of 13 lakh is like this, because you are first disallowing 3 lakhs and then you are again allowing 13 lakhs. So that's why Manisha Ben, the book answer is 13 lakhs because it includes this 3 lakhs. Deemed income is basically, that's what, see, we'll put it this manner. A scientific research, an asset under scientific research is basically sold, is basically transferred. So which means the sale consideration or amount of deduction under section 35, whichever is lower, will be treated as an income. So that's deemed income. What is the meaning of capital expenditure? Effort that was added while calculating disallowance for R&D, sir. See, if you are talking about this 3 lakhs, Subhashis, if you are talking about this 3 lakh, this is the revenue expenditure. So I'm first disallowing the revenue expenditure, again allowing 13 lakhs put together. So this 13 lakh as capital of 10 lakhs, revenue of 3 lakhs. So I think I've explained all your questions. What is another thing? What do you mean by plethora of tax? So plethora is basically too many things in mind. So it's basically not relevant to your what you call examination or something. When you say plethora of tax, it is basically more amount. So something that is excess. So there's too much of thing there. So the excess is the actual meaning of the word plethora. So it could generally mean that plethora of tax is basically too much of things that is explained or discussed. I don't know the context in which you are asking me. So the word plethora generally means excess or too many things. Okay, with that, we have concluded scientific research. I will start with 35 AD. I'll probably in another 10-15 minutes, I'll complete this 35 AD as a whole. And then probably there will be some what you call illustration. These are all book illustrations only, but I recommend you try solving on your own without seeing your institute study material. So basically 35 AD is specified business. Specified business. So what do you mean by specified business? Specified business or the business listed here. Or the business listed here, what are they? Cold chain, warehouse, that is storing agriculture produce or sugar, laying and operating business of gas, crude and oil, hotel industry, which is 2-star or above, hospital, at least 100 beds, 100 beds is there, housing projects, which is basically slum or affordable housing projects, fertilizer business relating to production of fertilizer, so transport hub. So there could be ICD or freight station. ICD is your customs depot. So international customs depot, which is being set up in India. So there is ICD or freight station. And then related to business of bee, the honey, right? Honey bee. So either you keep the bee or produce the bee. And then fabrication, which is in semiconductor water. Finally, infrastructure facility. Just know the business. Your study material would have probably given you the date in which this business should have commenced and all. It is relevant in your final. It is relevant in your final. For intermediate, I suggest you just know the business name. You just know the business names. Just stop it there. Don't try to go beyond that. Know what business alone it is eligible for. Please don't try to go beyond that. I don't think you will be tested beyond this point. So it's basically 100% of capital expenditure can be claimed as deduction. Something like your scientific research only, 100% of capital expenditure can be claimed as deduction. But here, not just land, even goodwill and financial instrument is not allowed. Which means when you purchase a goodwill, when you're acquiring a right, similar to scientific research, what did scientific research say? An expenditure relating to purchase of rights, acquisition of right is not scientific research. Same way here also not allowed. And then apart from that, financial instrument. So any financial instrument, that is securities, bonds, are also not allowed, because in some way or other this might not be related to the business. Again, the concept is this could be misused. So the land, goodwill or financial instrument is not allowed. So these business and similar to your fixed assets, 40A3 applies, which means if you have spent any expenditure, capital expenditure more than 10,000 in cash to a person in a day, that proportion of expenditure cannot be claimed as deduction under section 35 AD. And apart from that, similar to scientific research, your prior period investment can be allowed. But here it is not about salary, material and all. Capital expenditure prior to commencement. Capital expenditure prior to commencement can be claimed as a deduction in the year of commencement. So similar to scientific research, I am stressing the word similar to scientific research so that you link provisions. Remember, you link provision between 35 and 35 AD so that you know that when you remember one provision, you will automatically remember the other provision also. So 35 said preliminary expenses for 3 years prior to commencement in the nature of salary and purchase of material. 35 AD says in the year of commencement, whatever has been incurred earlier as capitalized expenditure is allowed. So this is what you're actually saying. Only thing is the condition here is, it says, even if you have invested earlier, it must be capitalized on the start of business. So even if you have invested earlier, it must be capitalized in the year of commencement of business. So that's the only condition different from scientific research. So this is what 35 AD is about. Okay. So now this 35 AD gives you 100% capital expenditure deduction on these business, right from cold chain to infrastructure facility, whatever is listed here. Please remember this business is alone. Don't go much deeper beyond that. Of course, it is important for you to know the provisions. When it comes to exam, just know the business name, just know what is not allowed, and just know what should be done for prior period also. So with this, you can stop the understanding of 35 AD for your exam purposes. Okay. Now, what happens if you are using that asset, for other than business purpose? In scientific research, what did we say? It will be treated as a deemed income the sale consideration or the deduction under section 35, whichever is lower will be considered as deemed income. Here also there is a condition, but here the condition is if within 8 years, if that asset is acquired or constructed. So basically, it must be used only for the purpose of specified business for the period of 8 years. If it is used other than the specified business within 8 years, then an income must be contributed. The deemed income should be contributed. How much? Total amount of deduction so claimed minus depreciation under section 32. What do you mean by that? Let's take for example, an asset was purchased on 12th April 19 for 10 lakhs. Okay. Now on 17th November 2022, they are transferring this asset. So now this asset is used for other purpose, not for the purpose in which it was claimed deduction. So in previous year, 2019-20, 35 AD deduction would have been 10 lakhs. Correct? Would have been 10 lakhs. Now, this 35 AD deductions of 10 lakhs is now used for other purpose business, which is less than 8 years. So you need to compute deemed income. What are they saying? Consider as deemed income. They're saying deduction allowed minus depreciation. Correct? So it says deduction allowed, total amount of deduction so claimed minus depreciation. So now we know deduction allowed is 10 lakhs minus depreciation. So how do you compute? Let's say for 10 lakhs, for understanding purpose, we'll use a fixed depreciation. So basically, first year I have provide 15%, that is 1,50,000. So 8,50,000. So this is what 2019-20, and in 2020-21, I'll again claim 15%. I'll again claim 15% on 8,50,000, which is how much? So it is 1,27,500. So my total will be minus 1,27,500. It will be 7,22,500. So the 7,22,500 will be the WDV on 31st March 21. Okay. Then for 22 also we need to compute. So 7,25,000 minus 15%. So again 7,22,500, right? So it is 7,22,500. So 7,22,500. So on that I need to provide 15%. So 7,22,500 into 15% is 1,08,375. So the total will be minus 1,08,375, which will be 614,125. So this is on 31/3/22, correct? Now it says depreciation. So depreciation is 1,50,000 plus 1,27,500 plus 1,08,375. So all these 3 years depreciation I need to provide 1,50,000 plus 1,27,500 plus 1,08,375. So 385,875 will be allowed as thing. So basically 10 lakhs minus 385,875, that is 614. So what will be treated as deemed income will be 6,14,125. So that's how you compute deemed income for the purpose of 35 AD. So this is what is discussed in your 35 AD. So 35 AD says, in case if you are using it for other business between 8 years, whatever deduction claim minus depreciation as if till date. So that's how you calculate it as your deemed income. So that will be allowed as a taxable under that year. It is not applicable for sick industrial company because they have no other purpose. They are already sick industrial company. So that's what it is about. So the entire sale proceeds plus insurance compensation shall be business income when the asset is claimed is demolished, destroyed. So I am not transferring, selling. So I am not using it for other purpose. I'm straight away selling it. So when I'm straight away selling it, there is no benefit. Whatever is your sale proceeds, plus in case if any insurance compensation received, will be treated as your income, will be treated as an income. So that's what it is about. So sale proceeds or original cost, whichever is lower. So sale or cost, whichever is lower, plus your insurance compensation, if any, will be treated as an income under section 28. If you are completely taking away the asset, that is you are selling or the asset got destroyed or whatever happens. The first situation we saw here is used for other purposes, This case we are talking about is completely selling it off, not about transferring to other business and all. You are completely selling it off. So what happens here is what discussed in second. And for this business to claim deduction, audit of account is mandatory and it has to be filed within the due dates. So that's what is about 35 AD. I'll take some questions of 35 AD. You can of course solve this question. I'll upload this slide. So I'll answer some questions and complete it. Subhashis. I was talking about less capital expenditure when asset on which R&D benefit was claimed earlier was sold, sir. So what was capital? Oh, that is a cost. So when you say scientific research, your sale consideration minus deduction under section 35 minus capital expenditure. So this will be a particular item or deduction under section 35, whichever is lower. I think we took an example for that. Yeah, this is the example. So we are saying on 17th November, an asset of 10 lakhs, which was earlier claimed as deduction, is now sold. So the sale value is 3 lakhs. The deduction is 35. The capital expenditure is nothing but cost of the asset. So that's also 10 lakhs. So that is 3 lakhs. So the sale factor is 3 lakh. The deduction factor is 10 lakhs. That is whatever you have claimed as deduction. Whichever is lower will be deemed income. Subhashish, so revenue expenditure is not at all. See, it is generally allowed under business expenditure. Whatever 30 to 37, whatever section we are talking about, it is allowed. What is additionally allowed? Additionally allowed is what we call is capital expenditure. So apart from your revenue expenditure, apart from your regular deductions and allowances, additionally you can claim capital expenditure. Shruti. It is as we see in the module only. I have just solved it here only for the basis of understanding this. So whatever I discussed here as a solution here in 35 AD is only to make sure that you understand the concept. Solving a problem, of course, we have 3 problems on this 35 AD itself. You can try working it out. We will solve 1 or 2 in this next class beginning and then continue with the next slides. So all these 3 are relating to 35 AD only. 6, 7 and 8. All these 3 are relating to 35 AD. So you can try solving this. As I told you, it is steady material problem only. But I recommend, based on your understanding on this session, you try to solve it on your own. We will just discuss that in the next chapter before we proceed further. So with that, I'll wind up with this session. So thank you for the wonderful session. I'll see you in the next session. I think it's on 19th, day after tomorrow. So see you in the next session. Thanks a lot for the session.